Question 11. If a market is semi-strong form efficient, the risk-adjusted returns of a passively managed portfolio relative to an actively managed portfolio are most likely. A, lower, B, higher, or the same. I'm going to pull in this chart here to give us a quick refresh on the different forms of efficiency, market efficiency. So weak is going to include our past data, but not public or private. Semi-strong, which is what we're looking at here, is going to include past data plus public, but not private information. And then strong is going to be past data plus public information plus private information, is all priced in. So strong is going to be the most efficient market, where it's going to be the most difficult for an active manager to outperform because all of this information, public, private, past, is all priced in. Weak form is going to be easiest for active manager to outperform since less information is priced in. Semi-strong is a little bit more of a gray area, but since public information is priced in, that's going to tell us that it's going to be a lot harder for an active manager to outperform. And on aggregate, if one manager is outperforming, that's a zero-sum game, so another manager has to be underperforming. And active managers have higher fees, so that's also going to take away from the returns. So on average, our passive portfolio is going to do better for those reasons. So we're going to put that the passive portfolio most likely has a higher return, B. Question 12. An analyst is reviewing a company's financial statements and notices that the company's disclosures about operating costs are less detailed than its revenue disclosures. Consequently, the analyst must use broader, less specific forecasting tools. Which of the following is most likely an example of a broader forecasting tool the analyst might use in this situation? So we've got A, costs separated by different geographic regions, B, detailed breakdown of costs for each product line, and C, consolidated financial statements lines such as cost of sales. So the key things we're looking at here are the broader, less specific forecasting tools. The operating costs are less detailed. So which of these is going to be the least detailed? Costs being separated out by different geographic regions, that sounds like pretty high level of detail. And this specifically says detailed breakdown of costs for each product line. But we're looking for less detail. Consolidated financial statement lines such as cost of sales, that's just going to aggregate up a bunch of data. It's not going to be quite as specific, so that looks like what we're looking for. Answer C. Question 13. In the case of a share denominated in foreign currency, the appreciation of the foreign currency most likely A, increases the return, B, does not affect the returns, or C, decreases the return. So I'm going to pull some information here in just to kind of help with the walkthrough. So I'm just going to do a very, very basic example just to kind of illustrate how it's going to affect it. So let's say we're a U.S. investor and we're going to be investing in shares in the European Union. So we're going to be converting our USD to euro. So at the beginning, let's say the exchange rate is 2-to-1. So it's going to take me $2 to buy €1, or that'll be the conversion rate that we're getting for these shares. So at the end of the period, our foreign currency, the euro, is appreciating. So we've got appreciation of the foreign currency. So that's going to mean that the exchange rate that we quoted, US to euro, is going to increase. So let's say the exchange rate goes to US to euro is 3/1. So now it's going to take us 3 USD to convert to €1. So the euro appreciated. Now, if we sell those shares, or if we don't sell them, we would be able to convert that €1 back into 3 USD. So overall, our $2 is now worth $3. So we can illustrate here that this is going to have a positive increase on the returns since our US dollars are now, since we're getting more US dollars back for that foreign currency appreciation. Answer A. Question 14. Which of the following is most likely a disadvantage of market capitalization weighting? So we've got A, constituent securities are held in proportion to their value in the target market. So we can go ahead and rule this out. If we're using a market cap weighted index, the securities are held in proportion to their market cap, not any value, not any target market. So we can go ahead and rule that out. B, its simplicity and failure to consider other factors such as the volume of shares sold. So simplicity, that's really going to be an advantage of market cap weighting, because we're not having to figure out how we're going to weight the securities in our portfolio. We're simply just buying, and then the weights are going to be determined simply by which stocks go up and which stocks go down. The stocks that go up are going to have higher weightings. The stocks that have gone down are going to have lower weightings. And because of that, we're not having to rebalance or trade the portfolio much. So volume is not going to be as important of a consideration in this type of weighting index. So I think we can rule out B, but let's just make sure C sounds correct. Constituent securities whose prices have risen the most or fallen the most have a greater or lower weight in the index. So this is kind of what we were just talking about in B, and it's an issue we're seeing today in 2024. You have these huge companies like Microsoft and Apple and NVIDIA, where they keep rising in price and their market cap weightings just keep getting higher and higher and higher, and it makes these indexes like the S&P 500 and the NASDAQ 100 look a lot more like concentrated tech portfolios than diversified U.S. stock portfolios. So all that to say, answer C is correct. Question 15. Sadine Nagaro is an equity analyst who is evaluating Pyron Corporation. The firm is a public limited company that manufactures lifeboats. So we've got some financial information on them here: total assets, total liabilities, revenue, number of shares outstanding, and market cap. From the data given above, the difference between the per share market value of equity and the per share book value of equity is closest to. So for this question, we're going to need to find two values here: the per share market value of equity. So that's going to be our market cap over shares outstanding, essentially. And then we're going to need to find the per share book value of equity, which, let me just pull these formulas in here. So we've got market value per share. That's what MVPS stands for, which is just going to be that market cap, 393.75 million over the shares outstanding. And then book value per share, BVPS, is going to be our assets minus liabilities over those shares outstanding. So we're given all the information we have here. We're just going to need to calculate these two out and then subtract them from each other. And just to note, the revenue thrown in there is not going to be relevant or used for this. All right, so we've got our market value per share, pulling that number in and dividing it by the shares outstanding, we get 45. And then book value per share, that assets of 575 million minus the 225 million liabilities. And then we're going to subtract those shares outstanding again, gets us to 40. Take 45 minus 40, gives us 5. So we'll go with answer A. Question 16. The most recent annual dividend declared by Creed Inc. to all shareholders is 78 cents per share. The stock is currently trading at $28 per share. Analysts expect the dividend to grow at 4% per year, and the required rate of return on the market is 8%. The intrinsic value of the stock is closest to. So we're going to be using the Gordon growth model formula here. So let's pull that in and talk through it. So VO is going to be our intrinsic value of the stock, and then these two formulas are exactly the same. But this is where we can get kind of tripped up. So we need to determine whether they're giving us the dividend in period 0, where we would need to apply the 1 plus G, or whether they're giving it to us in D1, which would be next year's dividend, essentially. So since it tells us the most recent annual dividend, I think that tells us we're going to be looking at DO. So that DO variable is going to be the 0.8 or 0.78 per share. So then we're going to need to multiply that by 1 plus 4% per year, which is what the expected dividend growth is. So we'll multiply that out up top, subtract, and then we'll divide that by R minus G. So our R is going to be that 8% required return, with G again as the 4% per year. So we pull all that together, punch it into our calculator, and we get 20.28 per share. So we'll go with answer C. Question 17. Which of the following is most likely an external factor affecting a company's capital structure? So we've got existing leverage, market conditions, or capital structure policies. So when we're looking at these, an internal factor is likely going to fall under the category of something within the company's control and or a decision that they've made inside the company. Really something that the company can go ahead and change if they want to. Whereas external is going to be something that they can't really control, like a economic recession or huge technology change or shift in consumer preferences, something like that. So looking at these answers, we've got existing leverage. This is going to likely be internal, since how we fund our company is partially going to be determined by the market and cost of capital for us. But we can determine how much money we want to raise from equity versus debt versus founders funding from their own personal funds. So I think we can go ahead and cross out A as an external factor. B, market conditions. This sounds like it could be our answer, since it's generally going to be out of our control. This is going to be, we can't determine the demand for our own products always, and we're not sure how consumer preferences are going to change and stuff like that. So this is likely going to be an external. But let's make sure we can rule out C. Capital structure policies. This kind of goes along with exactly with what we were saying with A. We can determine how much leverage we're going to take on, or and make those policy decisions internally. So we can cross that off, and we'll go with answer B, market conditions. Question 18. Based on the data provided in the following table, the cash conversion cycle of Armenia Limited is closest to. So we've got sales, cost of goods sold, accounts payable, accounts receivable, and inventory. So we're going to be using all these figures in some way or another to calculate our cash conversion cycle here. So let's pull the formula in. We've got cash conversion cycle equals days inventory outstanding. Basically, how fast do we sell our inventory? Days sales outstanding, which is going to include that accounts receivable. So this is going to be how fast or slow we get paid after making a sale. And then days payable outstanding, this is going to be how fast we're paying our own vendors. So it's kind of the inverse of the day sales outstanding. So let's walk through the numbers here. So we've got for days inventory outstanding, we're taking that average inventory over COGS. So we should have 220,000 over that 1.94 million. We can see we've got that here. And then I think I might be cutting that off a little bit. Let me pull this over further. And then we're going to multiply that by 365, which is what we're doing on all these in order to convert it to days, since that's what the answers are all asking for. Days sales outstanding, we've got our average accounts receivable over sales. So we've got that 440 in the average accounts receivable over the sales number, 2.99 million, which is what we have here. Again, converting that to days by multiplying by 365. And so to note, like this figure in here would be the turnover ratio. So this would be the inventory turnover ratio. And then we're multiplying it by 365 to get that days conversion. And then days payable, we've got that 310 in average accounts payable over our cost of goods sold, which is, again, is that 1.94 figure. So we've got 41 So if we go back to that original formula here, we're basically going to take the 41.44 in DIO, add 53.78, and then subtract out the 58.35. And so we pull all that in, and we see we get 36.87 days, so we'll round up and go with A, 37 days. Question 19. Which of the following statements is or are most likely accurate? So we've got 3 statements here, and then our answers are some combination of each of these statements. So it'll be either statement 2 is accurate, 1 and 3 are accurate, or 2 and 3 are accurate. So let's walk through these statements. Statement 1, in a best effort offering, the underwriters buy an issue and use their best effort to sell the issue to investors. So there's 2 parts to this. The agree to use their best effort to sell the issue. This is going to be true, but in a best effort offering, the underwriters are not buying the issue. They're just agreeing to sell as much as they can. So that one is not going to be correct, so we can rule out 1. And so we can then go to our answers and rule out any answer that has 1 included in it. So we can cross off B. So it's either going to be 2 or 2 and 3. Question 2, in an underwritten offering, the underwriters buy an issue and then attempt to sell the issue to investors. This is a correct description of an underwritten offering. The investment bankers are taking on the risk here since they're buying the issue, and then basically what they earn is what they sell it for above the price they bought it at. So this is going to be correct. So we need to figure out if 3 is correct or not. A best effort offering is the most common type of offering. That's not going to be true. Underwritten offering is going to be the most common type. And the main reason for that is kind of what we mentioned in statement 2. When companies are wanting to raise capital, they want to know how much capital they're going to get. And so by doing the underwritten offering, the company is getting their set guaranteed cash. And then the underwriters are going to get their payday from selling it for over that amount. So this is a pretty common way, since the companies likely want to raise cash for some specific thing and need a certain amount. So this gives them that set amount. So since 3 isn't correct, we'll cross that off and we'll go with A. Just statement 2 is correct. Question 20. Open Limited has average days of receivables of 50 days, average days of inventory of 40 days, and average days of payable of 30 days. Port Limited, operating in the same industry, has a receivables turnover of 6 times, inventory turnover of 12 times, and payables turnover of 9 times. Given the information, what is the most accurate statement? Port Limited has a shorter cash conversion cycle than Open. Open has a shorter cash conversion cycle than Port, or the cash conversion cycles for the companies are approximately equal. So we're going to need to find the cash conversion cycles for each of these in 2 different ways, because we're given the information in different ways. So for Open Limited, it's going to be pretty straightforward. Let me pull our formula back out here again for cash conversion cycle. So we've got days of inventory, which we're given right here of 40. And we've got days of receivables given right here of 50, and minus those payables, which is 30. So we can pretty quickly bring this in. We've got Open Limited's at 60. So now we need to just figure out Port, their cash conversion cycle. And so since we're given it in the turnover format, we're going to need to convert that to days of inventory, days of receivable, and days of payables. So in order to do that, we're basically just going to take each of these different items, and we're going to do 365 divided by them. So we'll have 365 over 12 for our inventory turnover, and then we'll do 365 over 6 for that receivables, and 365 over 9 for payables. So let's pull that in, see what that looks like and what the final answer is. So we've got that 365 over 12, and I just went ahead and did the adding part of the cash conversion cycle all in one. So we've got 365 over 12 plus 365 over 6 minus 365 over 9 gives us a little over 50. So we can conclude that port has a shorter cash conversion cycle than open, so we'll go with A.